Hey, what's up, guys? Jimmy Jackson here. Making another video for you. Licensed realtor Keller Williams, GR North. So, I'm making a quick video for you about what lenders look for in a loan application. So, trying to make my videos quicker. I'm at home, so not in the office today. So, yeah, guys, let's just jump right into this. Um, I might be repetitive. Some of my other videos I talk about the same concept, but I talk about it in different ways, like adjustable rate mortgages. If I'm talking about, banks, if I'm talking about even real estate investment trusts, if I'm talking about brokers, lenders, I might touch base on these same topics. So it might sound a little repetitive to some people who's watching videos, but if you didn't watch my other videos, then this might make sense. So, let's go. Let's jump into it, guys. So, yeah, these are things that a lot of home buyers are curious about, but they don't fully understand. It's like what the lenders look for when applying for the mortgage. So for a lot of people, it can feel like a mystery. You submit documents, you wait for approval, and you hope everything goes smoothly. But lenders are not guessing. They're evaluating specific financial factors that determine whether your loan is safe. Um, is a safe investment for them. So, you know, let me ask you a question. I might have asked this before, but why can two home buyers apply for the same mortgage on the same day for similar homes and still receive different approvals or different interest rates? You know what I mean? And the answer comes down to how lenders measure the risks of the buyer. If you have a friend or family member, one works full time, the other one's on welfare, not to discriminate against welfare, or they work part time. One asks for $100. All three of them ask for $100. This says it's three people. Who do you think is going to pay you back quicker? Who's more likely to pay you back? Who might tell you to wait till tax season? So that's a way to look at it if you're the bank. But they look more in depth. You know what I mean? They look at your job history, your credit score, how likely you are to pay them back, who you haven't paid back. They do a lot more in depth looking. So, they just think about it. Which buyer is likely to pay me back over the longer time? Because they're giving you like 30-year mortgages to pay them back on hundreds of thousands of dollars. So to answer that question, they look at several key factors of your financial profile. Like I said, number one is your credit history. So this includes your credit score, your payment history, your outstanding loan balance, how long you've been using your credit, if you just started your credit or if you've established it for long periods of time. Because your credit history gives lenders a picture of how you've handled debts in the past. Maybe you find you have filed for bankruptcy in the past and now you built your credit up. Maybe you're more reliable, which you weren't that reliable in the past. Maybe you're just becoming more reliable. Who knows? A higher credit score generally signals the better reliability. It can help you qualify for a better loan, lower interest rates. It just depends. But even if you have a credit score and it's not perfect, lenders look at the overall pattern of your credit behavior too. So, factor two, income and employment stability. Your income and your employment, like I said before, lenders want to verify that you have a stable, reliable income to support the mortgage payment. They'll review pay stubs, tax history, employment history. For many loan programs, lenders prefer to see a consistent work history. They call your employee and ask for W-2s. They'll look at your 401k. They'll look at all your stuff to make sure that you're reliable with your job history. This just helps them feel more confident that your income will continue. If you've been there for 5 years, they're like, okay, he's been there for 5 years. He's a good worker. Maybe we can count on him being there for another 20 years. If you go from job to job to job to job, they're going to be like, well, he's been there for a year, 18 months. Is he going to stay there? Third, your debt to income ratio. Don't panic. This compares your monthly debt obligations to your gross income. So if you have a car loan, if you have student loans, if you had credit cards, all those factor into this calculation. A lower debt to income ratio lets them know you have room for a mortgage. So you're not that high of a risk for something like that because you don't have tons and tons of bills every month. If a brother's getting hit with $1,000 for child support, that's going to mess up his debt to income ratio. Let's keep it real. 4, your assets and your savings. That's like your 401k, like I was saying, or money you have in a savings account. If you have money in stocks, if you have money in a real estate investment trust, this includes money that you can put for your down payment, funds for your closing costs, and sometimes additional savings like reserves, for example. Lenders want to see that you have enough financial stability to handle a purchase and any unexpected expenses that come with it. Which, when you're buying a house, there's unexpected expenses. You have to put down an earnest money deposit. You have your closing costs. You have your down payment. Um, and, what else comes with it? You have a couple other things that come with it, but you want to make sure you have money but there is programs that can help you with down payment, closing costs. It depends who you go with. Some banks are better. Some credit unions are better. It depends who you go with. So having reserves can also show that you're financially prepared for home ownership, show that you work this out. Factor 5 is the property itself. Finally, lenders also evaluate the property. They want to confirm that the home's value supports the loan amount. That's why you get the appraisal. This protects both the lender and the buyer by making sure that the property is worth what is being financed. So when you apply for a mortgage, lenders aren't just looking at the number. Like, they're not looking at one number or one document. They're evaluating the overall financial picture, the credit, the income, the debt, the savings, the property, because all of these things together help factor in the approval and the loan terms itself. So basically, the good news is that when you understand these factors, it gives buyers the opportunity to prepare ahead of time. When you know that what lenders are looking for, you can have the strength and your financial profile to begin applying. That's why I tell people, don't panic. Come and meet with me. Come and meet with a lender. Talk so we can prepare you for these things so you know what to do. People ask me all the time, how do I buy a house? How do I buy a house? I don't know what to do. I don't know what to start. Come and talk to us. This is how you start. This is what you do. Let us get you started, guys. Be prepared, because if you're thinking about buying a house and want to understand the loan process, feel free to reach out. We can help you, because education always comes first. Okay. And I will say this, when you're getting different types of loans, like if you get an FHA, that's a government assisted loan. They're going to have higher standards. If they're going to give you a government assisted loan, they're going to want that house to be livable. You know what I'm saying? They're going to be like, hey, we're giving you money and it's a government backed loan. You only have to put down 3.5%, and we're going to help you with more. You're going to have to put down a lower payment. So we're basically really helping you out with the loan. So we expect that to be a good livable house. Okay. If you're putting down 20-25% with a conventional loan, they might be like, you don't got to put down you don't have to have the best house. It just has to be decent. You know what I mean? That's where, I can explain more to you when you get a hold of me. So it just depends on what you qualify for. Some conventional loans are only 3%. So it just depends. If you have any questions, if you just want to see what your home is worth, if you're looking to sell, if you want to get set up to buy, if you're looking for an investment property, if you want to know what different types of mortgages are, different loans, adjustable rate mortgages, balloon mortgages, balloon payments, land contracts, anything, get a hold of me and I'd love to help you out. Remember, never settle when you're getting a realtor. Only work with the best. Thank you and have a blessed day.